Jesse Livermore was a notorious stock market speculator during the first half of the 20th century. He was a major force on Wall Street in markets that were plagued by the same hopes and fears as today's. Jesse Livermore ended up making fortunes and losing fortunes, making fortunes and losing it again. He even added to losing positions of wiped-out companies in the belief they would recover. Having said that, spread bettors can learn a lot from Livermore's experiences. 1. How taking a huge position and adding to it can either make or break you. On the one hand, Jesse Livermore was one of the greatest traders to have ever lived, yet on the other hand, he was dangerous in that he could not control his emotions. Having run an account up to millions and then losing it, one would think this experience was painful enough so as not to be repeated. Yet when he painfully started from scratch, built his account into several million again, only to lose it in one bad trade, then the alarm bells should have started ringing. Anyone can make a mistake, but not to learn from it is fatal. Sadly, after repeating this event one more time, he could not face the thought of making a comeback again and took his own life. A particularly valuable section of the classic book Reminiscences of a Stock Operator describes Livermore's approach to buying stock. He would sell a quantity and see how the stock responded. Then he would do that again and again, testing the underlying demand for the issue. When his sales could not push the market down, then he would move aggressively to the buy side and make his money. Livermore's losses were part of a grander plan. He wasn't just losing money, he was paying for information. Look at it this way. If you put on a high probability trade and the trade fails to make you money, you have just paid for an important piece of information. The market is not behaving as it normally, historically does. If a robust piece of economic news that normally sends the dollar screaming higher fails to budge the currency and thwart your purchase, you have just acquired a useful bit of information. There is an underlying lack of demand for dollars. That information might hold far more profit potential than the money lost in the initial trade. However, whilst Livermore was a top trader, he never worked enough on his own psychology. Had he worked on a sound money management plan and strictly followed a plan for every trade, he would not have created this situation. The lesson? Even when you've become a successful trader, that one fatal mistake is always lurking in the dark waiting to hit you. Only by keeping on top of your emotions and working on your trading will you avoid running into a catastrophe.